Hey everybody, this is Josh and welcome to Beers with an Economist. Today we're going to be talking about money. In the last couple of episodes we talked about inflation and we talked about why Bitcoin is not money. And that's led to a lot of people wondering, well, what is money and what is our monetary system like? Isn't it backed by gold? Is that why it's valuable? The answer is no. And should it be backed by gold? Should we be going back to a gold standard to get rid of all this inflation? The answer is also no. And that's what we're going to talk about today over beers. So what is money? Well, money is a set of assets that we use to exchange for goods and services. It essentially makes trading a lot easier, right? So the alternative would be something like a barter economy, right? Where every time you want goods and services, you have to find somebody that wants something that you already have, right? Or something that you can trade for in terms of service. So me as an economics professor, right? Every time I wanted groceries, I'd need to find somebody that wanted to learn about money or needed some complex statistical analysis done, which would mean I'd probably go hungry a lot of days of the week, to be honest with you. Now, if you'll recall, in the last video on cryptocurrencies, we talked about the functions of money and that crypto served none of them. So a quick recap about those functions. In order for an asset to be useful as money, it has to serve three functions. It needs to be 1, a medium of exchange, 2, a unit of account, and 3, a store of value. A medium of exchange basically means that I'm willing to accept it for payment for my goods and services, and so are you, right? We're all on the same page about what's acceptable and spendable. Unit of account means that I can value any item, whether it be a good or service, in denominations of that money. And 3, a store of value means that the asset holds its value for a reasonable amount of time for me to be able to spend it later. Right? Okay, so what is our monetary system? Well, our monetary system is basically what we call a fiat currency. That is, it's money that exists because the government says so. And if you were to take out a piece of paper currency right now and look at it, you'll see a phrase on there. This note is legal tender for all debts, public and private. And that decree is called a fiat. And that is what makes our money exist. That is why it's a medium of exchange, because the government says it is. And we all accept that because it's our government and we have to. Now, what would be the alternative? In the past, there have been things like called commodity monies, right? Which is basically a asset that's used as money, but also has a different purpose, right? That for example, is like gold, right? Which can be used to make jewelry, or in modern context, things like electronics, or maybe rice, for example, has been used as a commodity money, right? Which could be used as food, or it could be traded as money. Now, commodity monies usually don't pop up very often and don't last very long. And that's because most things that people value, like food, don't store for very long. So it doesn't serve as a good store of value, right? And that's probably the main reason. And other types of commodities are often cumbersome to move. So it makes it difficult to trade them back and forth, which of course is the entire function of money, is to make trade easier. Now, when you say commodity money, a lot of people immediately think of the gold standard, right? Or gold as money. And so this is a bit of a confusing issue, right? Because those are two different things. So using gold as money and the gold standard are two different ideas. So let me break that down for you. Gold as money is a system that has existed for a very long time. And people often think that gold being used as money, or is used as money rather, because gold is valuable. Now, this reasoning is probably backwards, right? The fact that we think gold is valuable probably comes from the fact that it was used as money for so long. And the reason that it was used as money for so long, particularly in early societies, is because it served those three functions very well. So because gold, it has a low melting point and is also very malleable and it doesn't tarnish easily, it could be easily divided which helped it serve as a medium of exchange and a unit of account. And the fact that it didn't tarnish helped it serve as a store of value, right? So the reason that we think gold is valuable is probably because of its historical use as money, not the other way around, okay? Now, when we think about gold standards though, what that means is it's paper money backed by gold reserves, right? And this is something that the United States has a long and very, let's say, disappointing history with, okay? So gold standards date back to the 18th century in Europe, and this is when paper monies first started to become popular. And basically that's because gold is heavy and it's cumbersome to carry around. So banks started issuing banknotes as notes of deposit for people that had gold reserves at their bank, and people would spend those banknotes like money, okay? But when the first paper currencies began to be issued by governments, a lot of people didn't trust them, and so the banks would allow people to convert those paper currencies into gold in order to gain their trust, right? Now, this is just basically a consequence of people being resistant to change, not really that gold is intrinsically valuable. Here's the thing though, is those gold standards that existed back then never lasted very long. Every time a government tried one, they were constantly either suspended, revalued, or abandoned altogether shortly after their implementation. This has been true in most places, and it's been especially true in the United States, where we have two kind of embarrassing experiments with the gold standard. The first one, officially, well, let me take a step back here. So, gold standards were common in the US, particularly after the Civil War, when a lot of the state-issued currencies began to get consolidated as people trusted state-issued currencies less and less and less. Now, all of those gold standards were suspended during World War I because no country could defend the value of their currency in gold anymore. So there were no more gold standards after World War I. Here's the problem though. In 1918, after World War I, the United States decided it was going to double down on the idea of a gold standard, okay? So what they did was they issued a decree that all money printed in the United States had to be backed by at least 40% in gold reserves at a Federal Reserve bank. That is a bank that was a part of the Federal Reserve System. Now this essentially fixed the money supply that we had to the amount of gold reserves that was available in the banking system. Why is that a problem? Well, if you'll remember what happened after World War I, it was the Roaring 20s, right? So the US economy boomed post-war. Now, as the economy grew, the money supply didn't grow with it. So what that means is we were buying more goods and more services at a very rapid rate, but we had no additional money to buy them with. So the value of the currency continually increased, which is basically also known as deflation, okay? That is, the overall price level in the economy kept coming down. Now that may sound super sweet to you guys right now, especially since we're experiencing historic inflation, but this is a really bad thing for the economy. And it contributed to the buildup to the Great Depression and kept us from getting out of it. Now, how does that work? Well, basically, a currency that is experiencing deflation kind of arbitrarily redistributes wealth from borrowers to lenders. And that's because the money that the lenders get back from the borrowers after the period of the loan is worth more than it was when they lent it, which is a good thing for the lenders. Now, this led to a credit boom in the 20s. Banks and other entities were willing to loan large sums of money to individuals because not only did they get the interest payments from those loans, but the money that they got back when the loans were paid back was worth more than what they lent them in the first place. Now, this huge influx of available credit mostly got invested in the stock market. And I'm guessing at this point you're starting to realize where I'm going with this. People borrowed huge sums of money to invest it in the booming stock market. This pumped up the prices of the stocks beyond what could be defensible based on the growth of the companies themselves. And eventually in 1929, we had a massive stock market crash that was the catalyst leading to the Great Depression. So the gold standard was a major catalyst in causing the Great Depression. Now, what makes it worse is it was also a huge part of how prolonged the Great Depression was. And this is because the 40% reserve requirement limited the central bank, our Federal Reserve's ability to expand the money supply to deal with the growing recession. And so we ended up in this deflationary spiral where the Fed wasn't able to get us out of that depression by altering the money supply. Now, this basically, the only reason it got interrupted was World War II, which leads us to our next major failed experiment with the gold standard. And that is the Bretton Woods system that existed from the post-World War II era all the way up to 1971. Excuse me. So, what is the Bretton Woods system? So, after World War II, one of the things that most of the Allied powers realized was that economic downturns and major recessions lead to war, right? Desperate people often have trouble, crap, sorry. I was like, I saw it right before you stepped into it. After World War II, all of the Allied powers realized that economic downturns were a major catalyst into the World War. And they wanted to try to stabilize the global economy to help prevent the types of economic downturns that could lead to further major conflicts. Now, one of the ways that they did this with is what we call the Bretton Woods system, which was an agreement between many of the world's nations to a fixed exchange rate between their currencies. And so this would just make it way easier for businesses in each country to export their goods to other countries and to import goods from those countries because they would know exactly how much they would cost, right, without a fluctuating exchange rate. So it seems like a neat idea, right? Now, how did they anchor this? Well, the US being kind of the most stable economy post-World War II, everyone agreed to convert their money at a fixed exchange rate into US dollars. But that kind of made the US seem a little untrustworthy, right? What would they do with this power? So in order to appease the other nations, the US agreed to exchange dollars for gold at a rate of $35 per ounce. And that was, in a nutshell, what the Bretton Woods system was. Now, the problem with this system, of course, is that it fixed monetary supplies based on gold reserves at first, and the fixed exchange rate system required individual countries to do what's called defending their currency's value. And the International Monetary Fund was set up as a clearinghouse for essentially balancing the supply and demand of individual currencies internationally. So what made this fall apart? Well, throughout the 60s, as the US economy grew, well, really the 50s and the 60s, as the US economy grew, we quickly shifted from primarily an export economy, which was mostly booned on by the post-World War II reconstruction, to an import economy where we were importing a little bit more goods and services than we were exporting. And so this caused an accumulating supply of dollars on the international market, which we then had to defend by buying back those dollars with either gold reserves or foreign currency reserves, right? And if all this is getting a little too complicated for you, basically you just need to know that at the end of the day, all of the currencies had to balance out to about where they were when we started, okay? So, what made this fall apart? Well, throughout the 60s, as the US economy grew, well, really the 50s and the 60s, as the US economy grew, we quickly shifted from primarily an export economy, which was mostly booned on by the post-World War II reconstruction, to an import economy where we were importing a little bit more goods and services than we were exporting. And so this caused an accumulating supply of dollars on the international market, which we then had to defend by buying back those dollars with either gold reserves or foreign currency reserves, right? And if all this is getting a little too complicated for you, basically you just need to know that at the end of the day, all of the currencies had to balance out to about where they were when we started, okay? So By the late 1960s, this became an untenable position for the US. We could no longer defend our currency against its value based on the gold standard. So we were set with having to do a major revaluation. Now, when faced with this task, Richard Nixon pulled what's called the Nixon shock of 1971 and kind of unilaterally decided, based on his executive power over the Treasury, that the US was just going to completely pull out of the gold standard without alerting any of our allies, alerting Congress, or even the majority of his cabinet. So next time that you think that we have a crazy president, just imagine president just one day waking up and announcing that he's going to, upend the entire financial system of the globe that's existed for the last 13 years. All right, everybody, I got my beer and I didn't have to use gold to buy it. I paid in real money. If money backed by gold always, at least historically, ends up in disaster, how should we think about money? Well, again, money doesn't have to be backed by anything. It doesn't have to have value at all. It's really just a thing that we use to trade for goods and services to make that easier. The way I like to think of money is that this is a little certificate of achievement. So every time I provide a good or service that somebody else values, they give me this little certificate that says, you did a good job. And then I can take this little certificate to Publix and I can say, hey Publix, look, I did a good job. And they're like, that's awesome, here's a sandwich. And the cycle continues on and on and on. So that's how you should think of money, not as something intrinsically valuable like gold, but just as a placeholder, a little certificate of achievement for doing something valuable for somebody else. So the recap here is that gold has no intrinsic value whatsoever. The reason that we associate gold with value is because of the long society's memory of its history being used as money. The other thing is that gold standards, that is paper money being convertible to gold, was never really the norm, and it was always just a way to kind of convince people to use paper money to try to gain confidence, that is, influence people using it as a medium of exchange. The third thing is that every time that we've tried to use gold standard money, it's been a complete disaster, right? Most notably in the US, after 1918, the gold standard that we used both was the catalyst for the Great Depression, made the Great Depression worse, and prolonged the duration of the Great Depression. And finally, the ultimate test of a gold standard was the Bretton Woods system, which was an agreement between 44 nations to an international fixed exchange rate system based in dollars that were convertible into gold. And that system, that was the basis of the entire global economy, collapsed after only 13 years. So gold was never a good monetary system, and there's no way that we should go back to it.